Welcome, everybody. I'm Mark Peter Davis, managing partner of Interplay. I'm on a mission to help entrepreneurs advance society, and this podcast is part of that effort. Today, we've got Phong on running through maybe not the most exciting of topics, but one of the most important for founders is how to think about valuation at the seed stage. It's abstract. The companies typically don't have much in the way of financial KPIs, yet you have to kind of come to a deal with counterparties to get capital in. How do you think about that? How do you thread the needle? Phong takes us through it. Enjoy. All right, Phong, we're back at it.
Hey, Mark. How you feeling today?
I feel great.
Good. I'm excited to talk about our topic today.
Yeah, what is our topic?
It's really one of the things that we work a lot with our incubator companies on. It's one of the most debated topics in early stage fundraising, which is how do you value a pre-seed company? So the reason why this is tricky is that the companies at this stage are so early, right? A lot of them don't have revenue. They don't have traction. They have unproven business models. So, how do you put a price tag on something that barely even exists? You can't really use all the stuff that they taught you in finance class, like discounted cash flows, revenue multiples. There's no cash flow to speak of, or if there are, they're negative, and there's no revenue. So, instead, I think pre-seed valuation at this point is more an art than a science, right? You're not taking out a big Excel spreadsheet and building this crazy model. It's really more around qualitative factors, investor demand, and market conditions. So in this episode, we're going to break down how investors approach valuation, the key methods that people use to price pre-seed startups, and then common mistakes founders make when they're landing on valuations with their investors.
This is an important topic because it is, especially get these founders who come in and they were bankers and they know how valuation is done when there's math to evaluate and cash flows. And the calculus would be that the entire company's terminal value, for anyone who does a DCF, they know what that is.
Right.
And that doesn't rationally work. It's just a gamble at this point. So yeah, this will help dispel some of the art to this craft.
Yeah, exactly. Coming at when I first started with my business school education, I was really kind of shocked at how this works, but it really makes a lot of sense. Before we dive into kind of the details of valuations and methods, let's just get the core terminology down. So every valuation conversation includes three numbers, right? The first is your pre-money valuation, which is what your company is worth before taking on the new investment. Then there's the investment amount, which is how much capital you're raising. Then there's the post-money valuation. So that's your company's value after receiving the investment. So that's pretty simple. Your pre-money plus your investment amount equals your post-money. And if you're wondering how much money to raise, you should check out our episode that we did a few weeks ago, how to determine how much money to raise. We're going to put the link in the show notes, but the quick recap is you should do an operating model and raise enough for an 18 to 24 month runway, right? You want to have enough money to hit your major milestones, but without excessive dilution. So now that we've gotten that out of the way, next topic I wanted to hit was, trying to understand what's driving investors and coming up with the valuation, what they're optimizing for. And the three things that you need to know is that investors need to balance three factors when they're structuring a deal. The first is they have to make the deal attractive enough to win over the best startups. It's got to be more attractive to these founders than other options that they have. For example, bootstrapping or debt or kind of, raising a small round with friends and family. They also want to own enough equity to generate acceptable risk-adjusted returns. And we can go into that a little bit later, what that means. And then lastly, they want to ensure that they leave enough equity for the founders and the key employees so that they stay motivated.
It's a bit of a balancing act, right? But the good thing is there's a lot of norms around this which help guide everybody into doing things that are culturally acceptable based on kind of the patterns that have already been developed.
Right. Totally. Now that you understand that, kind of the next part is really trying to understand 3 common valuation methods. And there are some other ones. We just chose these 3 because they're most commonly used. The first one is the investor target ownership method. So this is the most straightforward approach. Investors, as we mentioned before, want to generate a risk-adjusted return, an acceptable risk-adjusted return, right? They're taking on a lot of risk because it's an early company with no traction. Plus, they want to be compensated for the money and the time they're putting into the company. So a VC will determine how much ownership they need of that company to generate that return. And then they just back out a valuation based on that, on the investment amount. So, for example, if an investor puts in $1 million and they want to own 20% or 1/5 of the company, then the post-money valuation is 1 million times 5. So that's 5 million. And then and then they put in 1 million. So that means the pre-money valuation is 4 million. Super simple and straightforward. Investor just optimizing for what they want to get out of the investment.
What's interesting about this is VCs can't really underwrite each individual company to particular outcome targets, right? They might say, hey, we could see this becoming $100 million, $500 million, or billion, but they're not going to know it's $100 million or $125 million exit. There's too much unknown around what these outcomes are going to be. So generally, the VCs are simplifying what their ownership targets are when they're starting to put together their fund. And they're applying that generally to all of the companies. So it's, they'll flex up or flex down depending on where they perceive or sense risk. But it's unfortunately a lot less quantitative than you might expect in other types of calculations. It's very qualitative.
Yep. Specifically in that one, and in this next method that I'll talk about too, also very qualitative, although you are adding up some numbers at the end. And this next method is called the Berkus Method. It's the risk-adjusted method. And it's basically a way for investors to put a price tag in your startup without relying on financial projections. Instead, they're assigning a rough dollar amount to different risk factors, with the assumption that the more risk you eliminate, the more your money is worth, right? So it looks at 5 key areas that can de-risk your startup. So the first one is your team. So do you have the right people? Investors love a strong founding team. Co-founders with deep industry experience wins over solo founders who might get a little ding. So, if your team is top tier, maybe you can add $500 to $1 million to your valuation. Second factor is your market opportunity. Are you playing in a big space? Is it a massive market with a lot of demand? If it is, that's maybe another $500 to $1 million. If it's a niche market or one that's not that clear, that might knock you down. Third factor is your product. Do you have more than just an idea? Do you have a working prototype? Do you have an MVP? If you do, that'll add some, 500 to $1 million, let's say. Execution is another factor. Do you have a real plan? Do your investors believe that you have the ability to execute? Do you have a well thought out go-to-market strategy? If you can show a clear roadmap, then that's another 500 to $1 million. And then kind of the last factor is if you do have any proof of demand, early revenue, LOIs, a big wait list, whatever that is, could also add another 500 to $1 million. And again, these are just numbers, right? I'm just kind of casually throwing out numbers, not super scientific. But, based on those numbers, you could have no revenue yet and still kind of end up with a $3 million valuation.
Do you know of any firms that use this method?
I don't know specifically. A lot of times this is not visible how firms use that method. So I don't.
my sense, I don't know of any. I'm not saying they don't, but my sense is all of the people I've interacted with, and you don't always get to look under the hood. So I'm sure I have people in my orbit who might be using this. Most of the people are doing the first method that I know of, which is this simple triangulation based on benchmarks.
Yep. I think this is whether or not they're using this sort of kind of scorecard to actually do the valuation. These are the factors that they're evaluating companies on at least some level, right?
Absolutely.
Okay, so then the last method is don't value it at all and do a safe instead.
Very popular method.
Yeah, you're a big fan. Do you want to describe, kind of your thoughts on a safe and how founders should think about it?
Yeah. So a lot of the companies at the seed stage, it's really tough to put a valuation on. And particularly if you're raising from friends or family or people not in the venture ecosystem, trying to get them to triangulate around market norms and benchmarks might be hard because they don't have context. So historically, how this was solved was through the use of a convertible note. And convertible note was basically a loan, legally a loan, to the company with an interest rate. But there was an understanding that the loan would convert over into equity at the next financing. Now, this worked really well for a long time, but there was one problem. Convertible notes had an expiration date, which is kind of a requirement for a loan. And so sometimes the entrepreneur would go out and they'd be working on the company for 2 years and they haven't raised another financing. So the note has not converted to equity. It's still technically debt. And the lender, investor, even though they're coming in as an equity investor in spirit, they had legally and technically become in as a debt lender, would say, hey, give me my money back, which you can do with a loan when it expires. And of course, the companies had burned through all this capital and it was a mess. So eventually, Y Combinator came out with the SAFE. And the SAFE construct is great because it really aligns the spirit of what the convertible note was trying to achieve in practice. It creates a document, a structure where people can give the money knowing it's intended to turn into equity in the future. And it replicates all of those spiritual elements of the convertible note deal, but actually doesn't have this gotcha where people have to pay it back at the end if they go too long before raising the next round. So SAFE actually was this kind of cleanup and created this real alignment. Now, SAFEs can have all of the features that a convertible note had that the investors liked. They can have caps, they can have particular conversion structures, they can have discounts, they can have interest rates, they can do all the different things, the features that the convertible notes had. They just have removed the, hey, you have to pay all of the money back after a certain amount of time dimension that the convertible notes brought. So SAFEs are a great construct. I think they're wonderful for both entrepreneurs and investors. I think the key is that when they first came out, a lot of investors didn't like SAFEs who were used to the convertible note because they didn't realize they could put all of the features that were traditional in a convertible note into a SAFE, but that's all been worked out. So they are, to me, the gold standard and the common way to do constructs now. And the main thing, coming back to what Fong had started with, is with a SAFE, you don't have to actually value the company at the time of investment. Someone puts $100,000 in, and what you're saying is, in the SAFE structure, is this will convert to equity at a discount to the future valuation determined when a traditional, maybe more sophisticated investor comes in and puts a value on the company. So it defers that negotiation and decision-making till later. Still compensates the people for coming in early through the use of a discount. So they're getting some benefit for taking early risk, but it removes that whole bit of conversation. The other major advantage to SAFEs relative to doing an equity round is the simplicity. From a legal documentation standpoint and legal cost, it's really minimal. They're very cheap and easy to get done. Whereas when you do a proper priced financing, it's a bigger project for the lawyers. It takes more time. It costs more money. So this is kind of the low friction way to get some early money into the companies. Now, you see them most often used at the seed or pre-seed rounds. You don't see them used as often later in the game. Most of the companies move over to priced financings after that, where people are buying equity at a predetermined price and there's a negotiation, everything's happening right then. So,
and at a later time, presumably there's more data for which you could use to do a more accurate valuation.
Right. And there's also generally, as you get further into the game, you're dealing typically with more institutional investors who are comfortable in the pricing mechanisms of the legal constructs. Also, the economic burden of a financing is less significant when the company's bigger because maybe it costs the same absolute amount. Maybe it's tens of thousands of dollars, but that's a smaller percentage of the revenue in the business at that time. So it can be burdensome when the company might only be worth a couple $1,000,000 to spend 10, 20, 30, 40, 50,000 on a convertible financing or actual equity financing. So that's some of the thinking around the reason why safes are so interesting.
Yeah, great tool. So thanks for that. So that kind of wraps up kind of the three methods that are commonly used. I wanted to also talk about another factor, regardless of the methodology that you use, that can impact pre-seed valuation, is investor demand, right? So you kind of heard a lot about this in terms of generating FOMO. The more hype and buzz you can generate around your company, the more you can leverage investors against not against one another and kind of boost your valuation. So just wanted to put that in there. And then lastly,
let me add something to that. Yeah, mm-hmm. On the FOMO bit, I think it's important for entrepreneurs to understand the cadence of decision making for equity investments. The first thing VCs are just trying to figure out is whether they want to invest or not. And it's a bit binary. Is this an opportunity where you see huge upside, you believe in it, you think it's risk adjusted, and you're in or not? And then after you decide you probably are in, there's a evaluation of the investment structure. And the reason why it's a little bit of an afterthought is because the deal structures are usually pretty standardized. The new capital going into the company usually buys between 10 and 30% of the company, average of 20%. So it's not as though in some deals, the investors are getting 1% in a traditional VC deal, and in another deal, they're getting 50. There's a much tighter range. The legal terms also have kind of a tighter range. Now, VCs will duck out of deals if they think the terms are out of whack, right? And so that will factor into the decision.
Right.
But the driving up investor demand, basically, what I guess I'm trying to point out, it has a limit in terms of its impact on the deal structure. Now, there are outlier deals that get done where the valuations are kind of off the charts. That happens in every market cycle. It's happening right now. But within the rest of the market where they're kind of sitting within the norms, driving up investor demand might get your valuation, you're up enough where instead of selling 20% of the company, you might be selling 15 or 18. And these are important swings, but they're usually not changing the answer ultimately for the entrepreneur at their exit. So the FOMO is important. It is a tool for getting a lot of investors around the table. I would argue the greatest value it creates is for actually getting the deal consummated, making sure you get the right partners around the table. And third, it's the small churns of the dial on valuation, which can add up to make sure you're optimizing and minimizing your dilution. So just wanted to contextualize, there's the value of it, unless you're getting one of these outsized deals, is more about catalyzing a close in a time frame you like and getting the right partners.
Yeah. No, I think that's right. And kind of just piggybacking on this idea of, outsized deals and kind of the overvalued deals. I think it's also a watch out for founders too, right? It's great to have a higher valuation, but overly high valuations can price out some investors and potentially make future fundraising more difficult, right? So if you have an overvalued company, your milestones are going to be harder to achieve, and if you don't achieve them, it could potentially lead to a down round in the future. So that's just one watch out. I think on the flip side, don't undervalue yourself, right? So low valuations obviously lead to excessive dilution. And some investors, it might be a red flag to them. They might see undervaluation as a lack of confidence. So it's really about finding the right balance.
And the way to calculate this, we talked about in the last one, is figure out how much money you need, and then assume that you're gonna have to sell 20% of the company to get that money. And then you go to market, and everyone knows that's the basic framework. And either they're going to want to invest or not. And if the market's biting, you're going to get a deal. If the market's not biting, there's something wrong with the company, or maybe you should try to do it on less money. But there's these valuation considerations are very important, but they are not the first thought in the process for either party.
Good point. Great. Yeah, that's all I had. Hopefully that covers everyone's questions. It's pretty complicated topic, but I think just wanted to give some people something to think about for today.
All right. Hope that was helpful to everyone. And thank you, Fong.
Thanks, Mark.
All right. Hope that was helpful to everyone. Valuation, particularly at the early stage, is less arcane once you kind of dive in a little bit, and certainly very simple. It's far less complicated than you'll see when people are doing rigorous quantitative valuations. It's disturbing to many how simple it is, to be honest. But once you kind of get your sea legs around the simplicity of it, you can navigate and figure out and make sure you're getting a fair deal. The key thing is there are a lot of norms around the valuation ranges, norms around the amount of dilution, and even norms around the legal terms. So understanding where the market is, looking at some data sources, usually this isn't too painful of a process to actually work out the deal. The bigger question is, do people want to partner with you and your company? Once you get that figured out, it's usually a downhill roll. I hope that helps, and we'll catch you next time.